Construction firms regularly win multi-million-dollar bids with defined profit allocations, yet these companies routinely run out of cash before the roof is on. The assumption across the industry is straightforward. An estimator adds a 20% markup to the bid, and the owner expects to see a 20% gross margin on the balance sheet. Conflating these two terms is the single most common accounting error causing construction firms to go bankrupt. Markup and margin are distinct mathematical functions. They represent 2% light if we're looking at the same dollar. When a forward-looking multiplier is mistaken for a backward-looking percentage, it creates a structural capital deficit that exists from the first day of the project. To diagnose this deficit, we must separate out the three variables that make up total sales: job costs, overhead, and net profit. Job costs are strictly the direct field costs required to build the project. This is your labor, materials, and equipment rentals. Overhead covers the fixed and variable operating expenses required to keep the business alive, such as office rent, licenses, and administrative staff. Net profit is the mandatory residual capital. This is the money required to grow the business and absorb risk. Industry veterans target an 8% net profit, the threshold required to absorb unforeseen weather delays and material spikes, while still generating the capital needed to replace aging machinery. If a company fails to accurately isolate and define these three specific variables, pricing a project mathematically becomes impossible. The estimator approaches a project looking forward. They calculate the direct field costs and then apply a markup multiplier to arrive at the final bid price. The calculation here is simple. Markup equals the final job price divided by the direct field cost. The owner looks backward. They use gross margin as an historical metric to evaluate corporate budgeting and overall performance. Gross margin is the portion of that final sale price that actually contributes to overhead and profit. This chart shows how the trap springs on a hypothetical project with exactly $100,000 in direct costs. The estimator applies a 20% markup, pushing the total bid price to $120,000. The owner then calculates the margin on that final $120,000 sale. $20,000 divided by $120,000 yields a margin of only 16.6%. To match the estimator's multiplier with the owner's budget, the company must use exact translation formulas. Applying a 20% markup when the business requires a 20% margin creates an automatic 3.4% structural deficit. That structural deficit eats directly into the mandatory 8% net profit baseline before a single hammer ever swings. Mass market commodities rely on market-based pricing. If a soup manufacturer needs more revenue, they drop the price to increase sales volume. Construction produces unique, individual projects loaded with volatile variables. Lowering the price does not guarantee you will build more buildings efficiently. A construction firm must utilize strict cost-based pricing. The price is dictated entirely by the company's unique fixed overhead, regardless of what competitors charge. When leadership arbitrarily lowers a mathematically calculated bid to win a job, they do not lower the physical cost of materials or labor. That arbitrary price reduction comes straight out of the 8% net profit floor. Direct bidding based on external market rates instead of your internal cost structure is a mathematical decision to operate at a loss. That initial 3.4% deficit quickly leaves the spreadsheet and hits the job site. Contractors face a severe time delay. They must pay weekly payroll and vendor invoices long before they receive their monthly bank draws. This chart details how the structural deficit exhausts cash reserves. Physical work progresses, but available capital drops below zero. To survive the month, the company signs a new contract. Project B's cash deposit is immediately redirected to cover Project A's deficit. This is called front-loading. The company is now building Project B with missing capital. They will need a Project C to pay for Project B, initiating a cascading financial collapse across the entire portfolio. Front-loading creates the illusion of a cash management problem, but the shortfall is baked into the original estimate before a single bill is paid. The failure to translate markup into margin on day one manifests directly as an unrecoverable cash bleed on the ground. Breaking the front-loading cycle requires strict adherence to a single operational rule. A construction firm must calculate a unified markup factor based exclusively on its annual overhead and a strict 8% profit target. Subjective, variable markups designed to remain competitive in the market must be discarded. They guarantee mathematical failure. The 8% net profit target provides the buffer necessary to replace equipment and fund future growth. Any bid that dips below this threshold puts the company's long-term infrastructure at risk. Aligning the estimator's multiplier exactly to the owner's required margin ensures the company maintains the capital reserves necessary to bridge the gap between bank draws. Being competitive is an optional market strategy, but mathematical profitability through precise cost-based pricing is absolutely mandatory for long-term solvency.